Good morning, sir. We can hear you.
Okay, that's good. Okay, good. So it's 9 o'clock, so we can start our class immediately. So today we are going to continue from where we stopped last week. I said last week, yesterday. So yesterday I started with giving you the syllabus to showing you the objective of this course, financial reporting. And I told you that the objective of this course basically is to teach you how to prepare and how to present financial statements for both a single entity and group of entities. And in teaching you preparation and presentation of financial statements, we are going to be using accounting standards to teach you that.
Sorry, I can't hear you. Am I the only one?
Please confirm that is not the only one.
You're the only one.
We can hear you.
Yeah, the only one.
Okay. So you're the only one. You can maybe exit and come back in, or you increase the volume of your laptop. Just try that and see if it works. Okay, we continue. So in teaching you this first objective, we are going to use accounting standards to do that. So I'll be teaching you lots of accounting standards on almost every item that show on the financial statement. Also, we would move on to analysis and interpretation of financial statements, where we would use ratios to analyze and interpret financial statements. We would also deep dive into earnings per share under IAS 33, all in the bit of analysis and interpretation. Also, we are going to try to create an ethical thinking in you. You have to start thinking ethically as an accounting student until you qualify, so that when you qualify, your actions would be ethical. So ethics is also an important part of your syllabus that we're going to look at. Then we are also going to look at the impact of artificial intelligence and other technologies in financial reporting. How can technology make the work of accountants easy, especially in the age of artificial intelligence? We're going to look at both the positive and the negative side of it. Also, we're going to also look at sustainability reporting. I mentioned a snapshot of it to you yesterday via the body that is responsible for issuing sustainability disclosure standards. But we're going to just have a little insight into sustainability reporting because it is in your syllabus. So on a very high level, this is the objective of this course. This is your syllabus. I started our class 1 yesterday with regulatory framework. We cannot just start preparing financial statements, analyzing, doing all of that without knowing where we came from, which is the regulation. Who is our regulator for financial reporting? So the class 1 we looked at yesterday on regulatory framework basically focus on regulations that governs reporting and also the regulatory bodies. The regulation that governs reporting, I told you, is GAAP, which is generally accepted accounting principles. And this GAAP There are three of them. There is the accounting standard, which is the IFRS and IAS that we use in Nigeria. It's a global standard. We only adopted it in Nigeria. There is the company law, like the tax laws, the CAMA, the BOFIA, the Financial Reporting Act. Even there's this Nigerian Insurance Act that was just enacted in 2025. And also, aside company law, there's the local stock exchange listing rules or listing requirements, which are basically rules developed by SEC for companies that are listed. These rules requires them to meet certain conditions before they are listed. And when they are listed, they must continually comply to these rules in terms of reporting. So it is a gap because it has serious impact on how, on the shape and form of their reports. So this is the gap. Even though our focus is accounting standard, but know that when we talk about our regulation in reporting is beyond the accounting standard. It includes company laws and local stock exchange listing requirements. In case you're asked in the exam about gap, you need to be able to talk about these three. Then we were able to establish that rules and principles are not the same. Rules are strict, written. It assumes that you know it and you must follow it as it is. If you don't, you would be penalized. And there are some regulatory system or reporting system that are rule-based. Like for our gap now, the company law is rule-based because it's strict, written. You must follow everything to the letter. Even the local stock exchange listing requirement also is rule-based. You must follow everything to the letter. But when it gets to the accounting standard, the IFRS that we use, the accounting standard is principle-based because principle only gives you fundamental truths that provides the basis for a chain of reasoning. It gives you the guide for you to start thinking. That's principle, and that is the way IFRS is developed. It gives you sets of principles, and it allows you to think with regard its application to your entity. So in Nigeria, we can say that our reporting framework or our regulatory system is a mixture of rule and principle. And I give you an assignment. I said you should look at the advantages and the advantages of rule-based and principle-based framework, right? So yeah, between yesterday and today might be short, but it's something you need to review and look at. So I'll give you till our next class before we review it. Now, we then went on to the regulatory bodies. I told you that the regulatory body, our regulator for reporting for IFRS compliance and adoption in Nigeria is the Financial Reporting Council of Nigeria, who is headed by Dr. Rabi Olowo. And this entity requires all organizations, all entity to submit their reports to them so that they can look at it and ensure that every company is complying. And also they require all professionals that have input into the financial reports to be registered with them. So you guys now, when you qualify, you would be required to register with the Financial Reporting Council of Nigeria. However, their touchlights, they majorly focused on public interest entities. And I give you examples of public interest entities. These entities are required to submit Now they have an online repository where they can easily submit their accounts to FRCN, where FRCN will then look at it and ensure they are complying with the reporting standard, which is FRCN, which is IFRS. I also gave you the objectives of the FRCN and I told you that the most important objective they have is to protect the interest of investors and other stakeholders. They teach companies about corporate governance and financial reporting, and they ensure that they adopt or follow their teachings. And that's the first four objectives here. And ultimately, all these actions will improve the credibility of their financial reports. And I told you that they operate based on department. They have different directorates, from the Directorate of Accounting Standard, both in the private and public sector, and all that. Then I told you that the FRCN does not develop the IFRS, they actually adopt it. There is a body, a structure behind IFRS, which we call IFRS Foundation Structure. I told you that it is a three-tier structure comprising of the monitoring board, not board, the IFRS Foundation, and the standard setting body, which is the IASB and ISSB. And I explained all the details of this body to you. And we ended the class with the standard setting process, or how IFRS is developed. And I made you understand that the process of developing IFRS is an open, transparent deal process. Everybody is involved. In as much as you're interested, I give you 4 steps, from agenda consultation, where they come up with a work plan, to research program, where they document their research reports in a discussion paper, which ultimately will be sent out to the public for discussions. And they will go on to standard setting program, where it starts with a proposal for an accounting standard, which is documented in an exposure draft that's been sent out to the public. And it is this exposure draft that eventually becomes an IFRS. And they also engage in post-implementation phase, where they review the applicability of this standard and the easiness of the public in adopting and applying this standard that has been issued by them. So basically, that was what we looked at last week. If you have not revised it, don't forget what I told you. It's consistency. You need to keep it simple, revising it every day, and everything becomes so easy for you at the end of the day. Now, today is our class 2, and I hope to start and finish conceptual framework. This is also 5% of your syllabus, and I can take it very seriously. And why do they take it very seriously? It's because of the nature of the topic, right? It's conceptual framework, meaning that is majorly the concepts that underpin financial reports. In fact, I told you that IFRS is principle-based, right? Meaning that it contains guidelines and all that. So, see, those principles that they use in developing those IFRS, that's this conceptual framework. In fact, let me write it like that. So, conceptual framework are the set of principles that's used in developing IFRS. So, which is why you find I can asking this this topic every diet. Because if you don't know this, you can't understand IFRS, because it's the set of principles itself. So ultimately, okay, as I was saying, this conceptual framework, really, it provides the basis. It provides the basis for the development of new IFRS and for the updates of existing IFRS. Let me not just say updates, for the updates or amendments. Anytime they need to amend any existing IFRS, anytime they need to amend any existing IFRS, they would basically use this conceptual framework. So it's a very important part of whatever it is we are going to be looking at. So now, looking at this conceptual framework, having a principle that provides the basis for developing new IFRS, that anytime they want to develop new IFRS, they have some set of principles already, which is exactly what we want to look at, those set of principles. So what are these principles? But before then, I want us to look at the advantages of even having a conceptual framework. I want us to look at the advantages of having a conceptual framework, because looking at it, can't they just sit down and develop conceptual IFRS on a need basis? Why do they have to come up with a set of principles first? Of course, it makes sense. It makes sense. Number one, because it makes the development of IFRS consistent and coherent, in the sense that, because all IFRS, right, that deal with specific transaction are developed from the same similar basis, the same set of principles, you find out that all the IFRS will be very consistent and their development will be coherent. As it is today, when you check all IFRS that deals with non-current assets like PPE, intangible assets, even biological assets, even from some financial assets that are non-current, you find out that their recognition criteria, their measurement basis, the disclosure requirement is so consistent and coherent. The same basis. Again, when you check standards that deals with liabilities like income tax, like provisions, like financial liabilities, you see that similitude in those standards. They're very similar. And the reason, because they are all developed from this conceptual framework, this set of principles that I'm going to show you today. So it makes sense to have conceptual framework, because it makes development of IFRS very consistent and very coherent. And number two is that it prevents political interference. Political interference in the process of developing IFRS, in the sense that politicians or the government of the day might want to influence the reporting system of a country, right? Because the way reports are presented can ultimately determine things like the GDP of a country, or the market capitalization of the stock market, or how foreign investors perceive a country, right? So if there is a basis of reporting assets of all major companies that their balance sheet size will look more attractive, politicians will want to interfere and ensure that people responsible for developing standards follow that route. But that is not possible because we have set of principles already, conceptual framework that we use. So nobody can come and tell us, why don't you? We have a basis for everything. So it prevents any uh, external or political interference. Number three is that it makes users understand that financial reporting is based on a common ideology. So with the conceptual framework, everybody knows that reporting is not just as it comes. It's not just about anyhowness. We have principles that we follow. So they know that everybody is speaking the same language. Reporting is based on a common ideology. Reporting is based on a common ideology. And also finally is that, sorry, give me 1 minute. Okay. And finally is that this conceptual framework can help in the treatment of unusual transactions. In the sense that if you have transactions that we don't know how to treat, what will help them to treat them is the conceptual framework. Conceptual framework can help us in the treatment of unusual transactions. So these are basically some of the advantages of the conceptual framework. Anything that have advantage should have disadvantages. Is there any? Number one is that a single conceptual framework, a single conceptual framework might not meet the needs of variety of users, because there are many users. So a single conceptual framework might not be able to meet their needs, right? Also, is that it might not make the work, of developing accounting standard any easier, make the work of developing IFRS any easier, like that. So these are basically some of the disadvantages of the conceptual framework. And also, I need to mention the purpose of this conceptual framework, as it were. For my explanation, number one is this conceptual framework will be very useful to the IASB. And what will it help the IASB to do? It will help them to develop new IFRS and amend existing IFRS, okay? Either the IASB or the IFRS Foundation, right? Also, it would also be very useful for the IASB also to harmonize and converge international accounting regulation. Let me try to be sure that you guys understand this point, that this conceptual framework can help the ISB to harmonize and converge international accounting regulation. Who can tell me how can it help them to do this? And remember, one of the objectives that I taught you yesterday of the IFRS Foundation is to harmonize and converge international accounting regulation, which means that they try to ensure that all countries of the world have similar standard by encouraging them to adopt IFRS. Those that don't want to adopt IFRS, they will ask them that, okay, let's make our standard easier, like what they are doing with the United States. United States is not adopting IFRS, but they are trying to converge IFRS with FRS, Financial Reporting Standard of the US. Like most updates they are making as of today, like the update they make to IFRS 9 on financial instruments, the update they made to fair value measurement on IFRS 13, the update they made to IFRS 15 on revenue, all now is now very similar to what is in the US. They are converging, they are harmonizing international accounting regulation. So it's part of what the IASB does. So we are now saying the conceptual framework helps them to do that, which means that if they have countries that do not want to adopt IFRS like we did in Nigeria, that they insist that they want to continue to use their own local standard, what the IASB can do is to ask them to use the conceptual framework. They will just encourage them, okay, we have something called conceptual framework that you can use to develop your own local standard. So if they agree, then it can really help them harmonize and converge, right? Also, it can help management, let me call them preparers of financial statements. It can help preparers of financial statements to apply the IFRS. Okay, preparers, people that prepare financial statements with the conceptual framework, they will understand the IFRS. They will be able to apply it in their work. Also, it can also help preparers. It can also help preparers to develop consistent accounting policies. It can help them to develop consistent accounting policies where there is no existing IFRS. So if there is a situation where they need to develop accounting policies, I told you yesterday that every company has accounting policy. That's how they localize the IFRS to their company. So in order to develop that, if there is no IFRS on an item, then they can use the conceptual framework to develop accounting policies. Also, it can also help users to interpret and understand the financial statements. Can help them interpret and understand the financial statements. Also, it can help auditors. To form opinion on the financial statements. Can help them form opinion on the financial statements like that. So, and if there are other users that needs to understand how IFRS is developed, they can also use the conceptual framework. And in fact, it can help the IFRS interpretation committee. Know that this committee, they are basically responsible for developing standards, developing interpretation where there are conflict of opinions, right? So this conceptual framework can help them develop those interpretations like that. So these are the purpose of the conceptual framework. Okay, now that's an introduction. Now let's go to this set of principles itself by looking at the contents of the conceptual framework. The content of the conceptual framework. So the conceptual framework content is divided into 8 chapters. It's divided into 8 chapters. So the chapter one, this talks about objectives of a general purpose financial report. Objective of a general purpose financial report. Chapter 2 then talks about qualitative characteristics of a useful financial report. Chapter 3 talks about financial statements and the reporting entity. Chapter 4 talks about elements of financial statements. Chapter 5 talks about recognition and derecognition. Chapter 6 talks about measurements. Chapter 7 talks about presentation and disclosures. And finally, Chapter 8 talks about concept of capital and capital maintenance. So all these you are required to know in the exam. So we'll pick each chapter one by one and we'll explain them. Then we are going to be done for today. Sorry. Okay. So let's start with chapter 1. Let's start with chapter 1. Chapter 1 that talks about objectives of a general purpose financial report. So this is the first principle in the conceptual framework. And this principle talks about the objective of a general purpose financial report. And you see, the objective of a general purpose financial report is to provide financial information about a reporting entity that is useful to existing and potential investors, lenders, and other creditors to enable them make decision about providing resources to the entity. So this you need to know as a financial reporting student, that the objective of a general purpose financial report is to provide financial information about a reporting entity that is useful to existing and potential investors, lenders, and other creditors to enable them make decision about providing resources to the entity. You see, from this objective, you can see clearly first that when we have a report, when you have a financial statement that is used by everybody, the aim, majorly what we are doing is providing financial information. So the first thing we need to sort is, what are these financial information? Yes, they say we are providing information about a reporting entity, about a company, about an entity generally, and this information must be useful to existing and potential investors, lenders, and other creditors. Three sets of people. I mean, that should tell us something, that these three sets of people mentioned here is so specific. Does this then mean that we are not providing information to just these three sets of people? Are there no other users, like the government, like the employees, like the international community, and a lot more users that we can have? Okay, we'll look at that. So these are the key issues here that we need to decipher. And the very first I would pick is this financial information. When we say providing financial information, what is this financial information? You see, this financial information is not statement of profit or loss, statement of financial position. It's not those statements. Those statements is just a structured representation of the information. That is what those statements are. What is the information itself? The information itself are: one, economic resources of an entity. Number two, claims against the economic resources of an entity. Number three, changes in the claims and economic resources. These are the information we provide to users anywhere, anytime, in every IFRS. All information we are providing does not go beyond these three. And when we say economic resources of an entity, do you know what we are talking about? Assets. When we say claims against the economic resources, we're talking about liabilities. When we talk about changes in claims, which means changes in liabilities and our economic resources. We are talking about income and expenses. We are talking about income and expenses. So look at this very well and sync it, because in front of you is everything I want to teach you. Every standard deals with this. It's not beyond this. This is everything. This is information. So all we just want to teach you is how do you then present this information? How do you present them? But these are the information that flows into the reports. Secondly, is the primary users of financial reports. Why am I calling them primary users? Calling them primary users because this conceptual framework has narrowed down the users to just 3 sets of people. And I can ask you that who are the primary users of a report? If you write any other thing apart from potential and existing investors, lenders, and other creditors, you'll be wrong. You'll be wrong. So that's why I'm pointing it out again, even though it's clearly spelled out in that objective. I'm just spelling it out again, that the primary users are potential and existing investors, lenders, and other creditors. So please note that. And it says to enable them make decision about providing resources to the entity. And I mean, this last sentence already explains why this set of people are seen as the primary user. Because they are the ones that are providing resources to the entity. Without them, there is no entity. If somebody does not invest in a company, if somebody does not have the mind of starting a company, no, the company will not exist. The company will not exist. If we don't have lenders, people that borrow us money at the day where we have nothing, that if they don't give us that lifeline, the company will die. Without them, the company cannot exist, an entity cannot exist. Or is it other creditor? Entities that give us supplies on credits, that gives us goods on credits, that say that we should go and sell. When we make money, we pay them. Those are the primary users. Those are the people we prioritize as far as financial. Every other one are secondary. They are secondary. Meaning that those ones are just there. They are just collecting from the company. But these are the people providing resources to the company. Without them, no entity. And that's why they are the primary users. So to enable them make decision, you see, the decision these 3 sets of people will be making is so clear. Is so clear. Like the investor, what decision will the investor be making? He will make decision on whether to buy or sell the shares of an entity. From the information you give him, he will make that decision that this company is doing well, is making good income, so let me buy their shares. Or this company is just wasting the money I gave them the last time. Let me exit this company, like that. Okay. Also, they can also make decision. They can also make decision on how to vote during AGM or any meeting for that matter. So they make that decision on the basis of the information you give to them. Lenders would want to make decision about, whether they should provide additional credit to the company, whether they should provide additional credits to the entity. And also, they want to have that conviction from the report you give them, whether the entity has the appropriate liquidity to settle the obligations. That would they be able to pay back? Can they pay back? Do they have sufficient profit, liquidity, and all of that? The same thing, the creditors the decision they want to make, they want to make decision on whether they should provide additional trade credits to the entity. So these are the primary users of a financial report and their information need. Okay. And lest I forget is that you see this financial information that is provided, okay, the above financial information are presented to the primary users using an accrual basis of accounting. Okay, is there anybody in this class that can tell me what an accrual basis of accounting is? Is there any one of you that can tell me what an accrual basis of accounting is? Anyone? Who is going to? Yes, Philip, please make it 12.
Okay, I will say accrual basis of accounting is an accounting basis that record revenue when earned, whether received or not, and expenditure once incurred, whether payment has been made or not.
Yeah, makes sense, Philip. That's more like it. So, to keep it simple, you recognize assets in your books, okay? When the asset is already in your possession, when you are already getting benefit from the assets, even if you have not paid for the assets, as soon as the asset is functioning for you, recognize it in your books. Not only that, liabilities, you recognize liabilities in your book when you are already getting the obligation, when you already have an obligation, when that obligation exists, even if you have not collected the money, even if cash flow has not been interchanged, as long as there is an obligation on you, as long as you have a liability, then you can recognize it in your books. So the only part Philip mentioned is income, that you recognize revenue and other income when you have already earned it, when you have already worked for it, you have worked for the money. So even if you have not received the money, even if you have not collected the money, you should put it in your books. The same thing goes for expenses. You recognize expense in your book when you have incurred the expense, right? When you have enjoyed a benefit. When you have enjoyed the benefits. When, like rent, for example, now, you have not paid rent, but your rent is due. You are staying in that premises. Even though you have not paid it, but for the fact that your rent is due, you recognize it in your books. Income, as soon as you have done the work, you have done what you're supposed to do, recognize your income, recognize your revenue. That is accrual basis of accounting. You see that is the direct opposite of cash basis. Cash basis, that one is on cash. You only recognize any of these things when there is exchange of cash. No cash, no record keeping. But accrual basis is complete because what we are going to be recognizing will be economic activities. It will show the economic representation of that company, not cash flow. People buy on credit, people sell on credit. So you will not recognize all that. People owe salaries. So you will not recognize all that. You will miss a lot of things. So all information that we are going to put in the report, everything I'm going to teach you, this conceptual framework is saying that we recognize it based on accrual basis of accounting, which is that let your information be recorded economically. Present the economic activities of your entity, right? Not cash flow. Yes, if the person later paid, or if you later received, then fine. We will net them off. But as the economic activities are happening, you need to put it in your books, okay? So I hope you understand my explanation. As a reporting student, a lot of us are used to explaining accrual basis as you recognize income when they are in and not when they are received. You recognize expense when they are incurred and not when they are paid. That's fine. But you need to understand the brain behind this. That if you don't recognize economic activities as they occur, you will miss a lot. A lot of things will be omitted from the books. A lot of activities would be omitted. So all your information from not just income and expenses, assets, liabilities, then income and expenses, as soon as there is a transaction, whether money is involved or not, as soon as there is an economic activity, put it in your books. And that's what accrual basis of accounting is talking about. So, accrual basis of accounting is an economic representation of an entity's activities. It captures all transactions that occur, whether or not there is an exchange of cash. Therefore presents all the economic activities of an entity. Okay, so that's the end of chapter 1. Chapter 1 really focuses on financial information, accrual basis of accounting, and the primary users of financial information and their information need. Now, chapter 2, which talks about qualitative characteristics of a useful qualitative characteristics of a useful financial report. So this wants to look at the attributes of a financial report. The attributes of a financial report. And what are the attributes? There are majorly two. Okay. So we have the fundamental characteristics, and we have the enhancing characteristics. These are the two characteristics of a useful financial report. And the first one, which is the fundamental characteristics. So these characteristics or attributes makes the financial report either useful or not useful. And their relevance and faithful representation. So the two fundamental characteristics that makes the financial reports useful or not useful is relevance and faithful representation, in the sense that if a financial report has these two attributes, then that financial report is useful. If a report does not have these attributes, then that report is not useful. As simple as that. It's either you have it and be useful, or you lack it and you are not useful. That means it is a fundamental characteristics, as its name is presented. The second one, which is enhancing characteristics. Enhancing characteristics. So these characteristics makes the financial report more useful or less useful. It makes it more useful. Meaning that if it has these characteristics, it's still useful, but it will be more useful. So if it doesn't have these enhancing characteristics, to be less useful. So, I mean, it's just better for it to be more useful by having them, right? So those are the enhancing characteristics, and we have comparability, verifiability, we have timeliness, and understandability. These are the enhancing characteristics. So I can ask you to write short note on relevance, faithful representation, comparability, verifiability, timeliness, and understandability. So when we say relevance, so you see a financial report is relevant if it is capable of making a difference in the decision that is made by users on the basis of the financial report. So a financial report is relevant if it is capable of making a difference in the decision that is made by users on the basis of that report. And this is very straightforward. If it is capable of making a difference. You see, an item is capable of making a difference if it has predictive value and confirmatory value. Finish. If it has predictive value and confirmatory value, then it is capable of making a difference. And when we say predictive value, it simply means that we should be able to use the report to make predictions. We should be able to use it to make predictions. If it has confirmatory value, meaning that in the future, it should be able to confirm our past predictions. We should, of course, it will, because meaning that this confirmatory value means that you will continue to operate on a going concern basis. Okay, that means that if that assumption is there and clear, it therefore means that it will definitely confirm your past prediction. And you see, when it comes to predictive value, there are a lot of things you are going to learn as we move on. When I start teaching you those standards, that you will see that, okay, I need you to get to a point where this conceptual framework will start making sense, right? Because when we say, how can we use financial report to make predictions? What is there in the financial reports that will be able to let us make predictions? I mean, there are a lot that is there. Number one is comparative information. You know, when we present our reports, we usually prepare 2 years, immediately preceding and the current year. That alone, it shows you clearly that you can use it to make prediction. In the sense that when you are seeing last year performance, you saw that a company last year made 20,000. This year, it made 50,000. You are seeing the growth rates. You are seeing the growth. Then you can predict that, okay, next year it should, all things being equal, it should even do better. So you can use it to make prediction by through comparative information that they provide for us. Also, the same IFRS 18 or IAS 1 requires public entities to provide what we call basic and diluted EPS. So at the end of the year, below your statement of profit or loss, you're expected to present information around earnings per share. And one of the type of earnings per share is diluted EPS. And diluted EPS means that if potential ordinary shares should become ordinary shares, what would be the impact they would have on our EPS? What impact would they have on our EPS? That is diluted EPS. So that helps make prediction because you're speaking about the future at that point in time. So user can easily know that, okay, our EPS might dilute and it might not dilute with this information. Also, when you look at standards like IFRS 5, which I'm still going to teach you, it requires companies to present what we call discontinued operations. They need to present discontinued operation in the sense that if you have a plan to discontinue a component of your entity, a branch of your company, IFRS 5 says that you must present that branch separately. you must separate it from the continuing operations. Let users see it that you are planning to discontinue. Not when you discontinue, when you are even planning to discontinue, you must already structure your reports by separating it into continuing and discontinuing operations. So that's how that, I mean, when they see that, they would be able to easily know that, this company wants to shut down some of its branches and all of that. So that is relevance, predictive value, confirmatory value. Now, there's something we call materiality. This ultimately determines relevance. Materiality determines relevance. For you to know whether an item is material or not, you need to identify, for you to know whether an item is relevant or not, okay, as in the context of the reports, you need to understand the materiality threshold of that company, okay? And see, an item is material if its omission or misstatement will affect the decision that is made by users on the basis of that report. Then that item is material. So there are some items in the account that whether you omit it or misstate it, it does not affect the relevance of the report. But there are some other items that if you misstate them, everything is gone. So there is no way we can talk about relevance without mentioning materiality. It is strongly correlated with relevance. That's why I'm mentioning it under relevance. Then another fundamental characteristics that a financial report should have is faithful representation. And this means that the financial reports should be represented the way they are. You need to represent the financial report faithfully. So this is like saying that don't manipulate the reports, right? Don't manipulate it. And when we say don't manipulate, when we say faithfully represent, what we are saying is this. You know that normally a financial report is an economic phenomena in words and numbers. When you see a report, your perception of a report should just be, okay, this is just talking about the economic activities of a company, both in words and numbers. That is what a financial report is. So what faithful representation is talking about is this. You see, those words and those numbers, represent them the way they are. Those numbers, if you made revenue, if you work for revenue and the money you're expecting is 100,000, it's 100,000 you should put. It's 100,000. Don't assume that it might go to 120. No. It's your economic activities we want to see. Nothing else. When you are describing your activities also in words, don't sugarcoat anything. Don't say what does not exist. Don't say what will not exist. It's that simple. So faithful representation. I say financial representation. Faithful representation simply means that your economic phenomena in numbers should be represented the way they are, faithfully. So these words and numbers should present what they purport to represent. So whatever it is you are presenting is what you should present. Faithful representation. So, you see, these words and number, let me call them depiction, because it's a depiction of your company. So for a depiction to be faithfully represented, faithfully represented, it must it must be complete, it must be neutral, and it must be free from errors. When we say complete, it means that all information and data, all your economic activities must be captured in the financial reports. If you omit anything, it becomes a problem with faithful representation. We don't expect you to omit. All your information and data must be captured in the report. Complete. Show us a complete depiction. Your depiction must be complete. Neutral. Neutral. You see, your depiction must not be biased. Don't have a mindset. So the depiction, the words and numbers must not be biased. Don't say because analysts have predicted that our company would make 2x our profit of last year, you are now manipulating your report to meet that. No, you cannot be biased. It has to be neutral. You present it the way they are. And free from error. Free from error does not mean that the report is accurate in terms of the numbers. It's not accurate, right? It cannot be accurate because we make use of estimates and judgments. It's principles we use in preparing account. So when we say free from error, this means that the process with which the report is, within which the financial report is prepared, should be free from error. Should be free from error. It should not be mistake in such. I mean, when you're applying accounting principles, like something you're supposed to capitalize, you now go to expense it. Something that is supposed to be that you're supposed to put in your books as an asset, you're putting it as an expense. Something that you are supposed to debit, you're crediting. You see, the process with which the financial report is prepared should be that one. That's free from error. Should be free from error, and also the description of the entities, economic activities should be free, should be error free. So free from error really focuses on the process and the description, right? Those should be clean. They should be free from error like that. Okay. And that's chapter 2 on qualitative characteristics. But so when you see me make all this writing error and all of that, you can always note it out, because otherwise I'll just send you right up full of errors. Okay. Before I move to chapter 3, there's something called substance over form. Substance over form. You see, it's not possible. It is not possible for a financial report to be faithfully represented, if the transactions are not presented in accordance with its economic substance over legal form. It's not possible. If you do not present your transaction in accordance with our substance, the full meaning, I just told you the full of this substance over form is economic substance over legal form. It's not possible for you to faithfully represent all this faithful representation I was talking about up here. It's not possible if your transactions are not presented in accordance with their substance over legal form. So when we say substance over form, we talk about economic substance over legal form, which means that we need to prioritize economic substance and not legal form. So there are two things here: economic substance, and there is legal form. So both exist in daily transactions: economic substance, legal form. So every transaction has a substance. Every transaction has a legal form. And the reality is that in most cases, legal form and substance are always the same. So economic substance is the economic reality of a transaction. It is the financial reality of a transaction. It's the economic reality. So when you have a transaction, like you go out to buy an asset, right? So the economic reality is that you own an asset that you control now, that you're going to use for your activities and will make money for you. And you have paid. That's the economic reality. The legal form is that legally you own an asset. Legally. So in that case, the legal form supports and agree with the economic substance. That's fine. No problem. But when you have situations where economic substance and legal form do not agree, stay with the economic substance. Record your transaction based on economic substance and not legal form. I'll give you two examples, right, that are popular that you would face in the course of this study. Number one is leases. When you lease an asset, the economic substance is that this asset is not your own. You have only borrowed it, right? And also, you are now using the asset to make money for yourself. You are using the asset to make money. So the financial reality and economic reality is that this asset is making money for you. And in accounting, anything that makes money for you is an asset. That's the simple definition of an asset in accounting. Anything that makes money for you. So the economic substance will say that this asset is making money for you. So put it in your books as your asset. But when you look at the legal form will say legally, this asset is not your own. You should not put it in your books. It's not your asset. Hence, there is a conflict between economic substance and legal form. So what the conceptual framework is saying here is this: stay with the economic substance. We follow economic substance. We follow economic reality. We follow financial reality. Even though the asset is not your own, but the asset is making money for you. So put it in your books as your asset. Recognize it in the books, even though it is not your own. Because that's the economic reality. It's making money for you, right? Another instance is let's say you sold an asset, right? You sold an asset, right? And this asset that you sold, you now told the customer that you are going to buy the asset back from him. Listen, I sold an asset to you. As I sold goods to you. I now entered an agreement with you that I will buy that item back from you at a later date. At a later date. You see, legally, based on the contract we have written, I have sold the asset to you. I have sold the asset. So the asset is no longer mine. In fact, I should recognize revenue because I have sold. But economic reality, what is happening here is that I have sold, yes, fine. But I'm going to repurchase it back from you. I'm going to repurchase it back from you at a later date. The reality is that I didn't sell. I didn't sell. All I've done is that I just took a loan from you and I used that asset as a collateral. I just collected money from you. I now covered it as if I've sold. I collected money from you. And now say I'll collect it back. I will buy it back. Meaning when I'm collecting back the asset, I'll pay him. It's like I'm returning the loan. So you see, you would appreciate, I believe that as we move on, as I continue to teach you standards, I want you to always bring back your mind back to this conceptual framework, because everything is on this set of principles in this conceptual framework. Everything we are going to be teaching you in reporting generally. So that is substance over form. You can only faithfully represent, right? If your transactions are presented based on the economic substance and not legal form. So economic substance looks at economic reality and financial reality of a transaction. This looks at the economic and financial reality of a transaction, while the legal form, this looks at the contracts or agreements in a transaction. That's what legal form looks at. And we rely on economic substance. we rely on economic substance. Now, let's go to chapter 3, financial statements and reporting. And so let me give you something to hold. Chapter 1 and chapter 2 is the most important in terms of asking questions in the exam. Questions are often asked from chapter 1 and chapter 2. So you would need to pay very, very close attention to those two areas. Now, chapter 3 talks about financial statements and the reporting entity. So this part, financial statement, is like a repetition of chapter 1 that talks about what a financial statement is. So it talks about, financial statements provide information about assets, about liabilities to a reporting entity. Okay. So this provides information about assets, liabilities, income, and expenses of a reporting entity. And he also explained to us what a reporting entity is. And this is an entity that is either required to or chooses to present a financial report. And this entity can be a single entity or group of entities. It can either be a single entity or group of entities. And this entity does not have to be a legal entity. It doesn't have to be a legal entity. So what we are saying here is this: a reporting entity can either be a sole proprietorship business, it can be a partnership business, it doesn't have to be a legal, a company like a limited, no. Any of them is okay. And this is basically what chapter 2 talks about. It also briefly talks about chapter 3, it briefly talks about reporting period, which is basically, this is the current and past periods. Okay, so when we talk about reporting period in reporting, it's talking about current and past, and which supports the fact that when you're presenting your report, you don't just present current year, you also present the immediately preceding period and also future periods as well, because we expect that financial reports should have predictive value. So you should give us some notes around your future plans and all of that. And also it talks about perspective of a financial report. Perspective of financial reports. And here it says that financial reports should be prepared from the perspective of an investor. From the perspective of the reporting entity, not the investors. So we are not, a financial report is reporting economic activities of an entity, not trying to not trying to please an investor. All we are just doing is just, this is our asset, this is our income, this is our expense. That's all we're doing. That's the perspective. We look at the reporting entity, nothing else majorly. Nothing else majorly. So that's chapter 3. And chapter 4 talks about elements of a financial report. So there are 5 elements of a financial report. 1 is assets, 2 is liabilities, 3 is income, equity, 4 is income, and 5 is expenses. So now we are deep diving into that financial information I spoke about earlier. So assets, I already told you that these are present economic resources, of an entities or economic resources that is controlled by an entity as a result of past events. So assets are present economic resources that is controlled by an entity as a result of past events. And you need to understand that when we say economic resources, we are talking about is a right. Okay, it is a right. The right that has the potential is a right that has the potential to generate economic benefits. So when you have a right that generates money for you, that's an asset. I told you that in reporting, anything that makes money for you is an asset. Okay. So when there is an economic resources, okay, when you have an economic resources, and it means you have something that makes money for you. It means you have a right that has the potential to generate economic benefits, both now and in the future. Right? That's why we say potential, okay, in the future. And controlled, it has to be controlled by you. It's not just about ownership of economic resources. You should have control over it. And control means that the flow of economics of economic benefits of the economic benefits comes directly to the entity. So meaning that whatever money that is made from that asset flows to you. So the flow of the economic benefits comes directly to the entity. If it doesn't come to you, whoever the economic benefit flows to, that's the person that has control, and that is the person that should recognize the asset in his books as his own, not the other way around. So typically, there are a lot of examples of an asset. I'm sure if I ask you examples of assets, you would quickly tell me furniture and fittings, plant and machinery. Yes, they are assets, but the picture here is beyond that. The picture here is beyond that. We are looking far beyond just physical assets, but we are looking more of economic resources. The focus here is anything at all, anything, whether tangible or intangible. In as much as that thing makes money for you and that money comes to you, that's an asset. Okay? That's an asset. And the second one is the liabilities. So liabilities, these are present obligation to transfer economic resources, as a result of past events. So present obligation to transfer economic resources as a result of past events. So you see, when you have an obligation, this is a duty, to act in a certain manner in which the entity has no practical ability to avoid. So when you have a duty to have in a certain manner and you have no practical ability to avoid that duty, you have an obligation. If you can avoid it, if you need to do something and you can decide not to do it and nothing will happen, that's not an obligation. You don't have a liability. For you to say liabilities exist, there must be a present obligation, right? And this obligation, so that you will not interpret it as just any obligation. The obligation here is to transfer economic resources, to transfer something that you own, money, assets, something you own, so something that is creating benefit for you. You have to transfer it, cash, something like that. Then you have a liability at your hand. You have anything. It's the list is endless, from your payables to taxes, like that. That is liabilities. Those are liabilities. Then you have income. And income, they are residual interest in the assets of an entity after deducting all its liabilities. So equity is the residual interest in the asset of an entity after deducting all its liabilities. So the key word here is residual interest. So when we say residual interest, let me even leave residual. When we say interest in the assets, who are those that have interest in an asset of an entity? You know that they are basically the owners, the shareholders, the creditors, the lenders, those primary users. Those are the people that have interest in the asset of an entity. Whoever whatever money the company makes, whoever owns that money, whoever collects those money, whoever gets returns from those money has interest. That's interest. So we're not talking about just any interest, we're talking about financial interest, right? So where your interest in an entity, in the asset of an entity, is residual, right? We call you equity holder. So if you are an investor, of course, obviously an investor has interest in the asset of an entity. If your interest is residual, which means that when they are paying dividends, when they are paying returns, you are paid last. You are paid last. Okay? You are equity. We call you equity. Not just the person now. Equity also involves that thing, that item they are paying last. Whatever is remaining is also equity. So equity is seen from the perspective of the person and also that thing we are paying last. And that is why when we say equity in reporting, equity is usually ordinary share capital, which is the person, right? Ordinary share capital plus reserves. You know, what goes to ordinary share capital is reserves, like retained earnings, like anything. After we have paid everybody, we pay ordinary share capital last. That's equity. And this is not me really talking in the strict sense of it, that nothing else can come as equity. Of course, something else can come in as much as that item is residual. That item is what is remaining. Then is equity. If you have a liability, though we don't expect a liability to be residual. But if it happens that there is somebody gave you money and the person is so patient and it tells you that you don't have to prioritize my repayment. After you have sorted everybody, come and pay me. That becomes equity. That's not liability anymore. That's equity. Even if you borrow money from somebody and the person says, don't worry, when you settle everybody, settle me. That's equity. That's substance. That's economic substance of equity. Okay? Residual interest. I hope I'm making sense to you guys because I really would not know because me don't know where you are. So the next one is income. Income, this is an increase in assets. Okay? When your assets increases, when it increases, is income. That increase in assets is income, right? So, for example, if the value of your asset not that you bought a new asset, that one is clearly not income. That is new assets. Okay. So, aside from buying a new asset, if the value of your asset increase, is income. Whether there was a revaluation, whether you make more money, is income. Increase in assets is income. Income is also decrease in liabilities. Not when you settle your liability. You're not talking about settlement of liability. You're talking about decrease either as a result of valuation or decrease as a result of maybe they say don't pay again. They forgive you a loan that don't pay again. A decrease aside from you making effort that you settled. That one is not income. Clearly not income because you settled. But anything aside that and your liability decreases is income. Okay? So increase in assets, decrease in liabilities during a reporting period, not over time, just for a year, during a reporting period, because income is for a year. It's usually for a period. Okay? And this will now result in increase in equity. Okay? And this increase in equity here, you're talking about when you make profits, your profit will increase either your share capital or your reserves. Okay? Profit is an income. Gains is an income. So when your asset increases and your liability decreases, it makes you make profit. So your equity will increase. That is an income. Okay. So this increase in equity, let me put it down, other than those, it has nothing to do with other than those relating to contributions from holders of equity claims, other than those relating to contributions from holders of equity claims. So which means that this increase in equity here has nothing to do with contributions from holders of equity claim, right? So that is income. That is income. And expense. So this is decrease. It's like the opposite of income. Decrease in assets, increase in liabilities during a reporting period. Okay, that results in decrease in equity. This decrease in equity is loss. Other than those relating to distributions to holders of equity claims. You know that distribution to holders of equity claims is dividend. Dividend is not an expense. So the decrease in equity here is loss. Is loss. When you make a loss, it's an expense, not the one that has to do with paying dividend. When you pay dividend, it also decreases your equity because you're paying dividend from your retained earnings, right? That is not equity. That is not expense. Okay. And those are the elements of financial. These are the elements of financial statements. Okay. And that's chapter 4. That's chapter 4. Chapter 5. So this is 11:50. Our class is supposed to end by 11. Can we take 5 minutes break? Then probably you guys should give us additional 30 minutes for us to finish up this topic. Okay, so let's go to chapter 5 that talks about recognition and derecognition. So two things here. First is recognition, which means how do you recognize or record items or all these elements that we have explained in the financial statement? Firstly, when we say recognition, we are talking about the inclusion of the elements in the financial statements. So that's recognition. Not just the inclusion, is the process of inclusion. And before you can recognize any of these elements in the financial statements, so and an element, when I say an element, I mean any of these 5, right? An element can be recognized in the financial statement or reports if it meets the following criteria. Number 1 is that it meets the definition of the elements in the conceptual framework. So if an item meets the definition, if it complies with any of these definitions that I've explained earlier, then you can go ahead to recognize such elements in the financial statement. Number 2, the element is relevant and is faithfully represented. So this is speaking to the fundamental characteristics. So in terms of recognizing an item in the financial statement, the conceptual framework is saying that such an item must meet the definition of the elements of any of the elements in the conceptual framework, and also the item, not even the elements, the item in question is relevant and is faithfully represented. And don't forget, relevance and faithful representation are the fundamental characteristics. So if such an item has those two fundamental characteristics, then you can recognize it in the financial statement, right? And you will see, when I start teaching you standards, all the recognition criteria for all standards This is the principle they all use. This is the principle behind them. Okay, this is the principle behind them. They look at definition, they look at the item and they see that it complies with the definition of any of these 5 elements, and they look at it and see it's relevant, it's socially represented. Then you can go ahead and recognize it in the books. Second is the recognition. And when we say the recognition in reporting, we are talking about the removal. This is the removal of an item from the financial report. Okay? An item can be derecognized or should be derecognized, either way, if it meets the following criteria. Number 1, there is loss of control of the item, meaning we have lost control of the item, then derecognize it, or the obligation from the item has been settled or extinguished, then we need to derecognize it from our books. So these are the 2 derecognition criteria. Before you can remove an item from the books, is either you have lost control of that item, or you have settled any obligation arising from the item. And that's chapter 5. Chapter 6 talks about measurement of elements or financial statements. And you see, the item that you recognize in the books are usually measured. And when we say measurement is the monetary amount that is attached to the item that is recognized in the books. We are talking about the monetary amount that is attached to the item. So this monetary amount that is attached to the item, we look at it with measurement basis. So this monetary amount is determined using the following measurement basis. So when you want to determine monetary amounts in reporting, is either you are using historical cost or you are using current value. These are the 2 measurement bases we have, and these are the 2 ways with which we measure items. So historical costs, this is the price that is paid for an asset or for an event giving rise to a liability. This basis does not change. It does not change. Historical costs measurement basis does not change. As soon as you identify the price that is paid for an asset and you put it in your books at that basis using historical costs, that is what it will be all through. It won't change. It does not change. The historical cost basis does not change. But when it comes to current value, this is also the price that is paid for an asset or for an event giving rise to a liability, right? This basis changes, and it is usually updated for changes. It is usually updated for changes in economic circumstances. So as the economic situation of a country is changing, current value is updated. Okay? And there are three types of current value. Current value is into three. Number one, we have current costs. And this is like the replacement cost of an asset. So replacement, I mean, when you want to get how much the cost of an asset is today, okay, you look at current costs. Two is current value. And this is the selling price of an asset. If you look at how much the price you will receive to sell when you sell an asset today, how much are you going to receive? That's fair value. That's also current value. And the third one is value in use, meaning you are not replacing, you are not selling, but you want to have an idea of the value today on the basis of the fact that you want to continue to use it. What's the inherent value? This is what we call evaluation. When you revalue an asset, one of the bases of determining its value is value in use. Now, okay, I'm not selling, I'm not replacing, but I just need to get the value today. So one of the ways that is using value in use, and this is determined by getting the present value of the future cash flows from an asset. Okay, so when you identify the PV of future cash flows of an asset, that gives you a sense of what the current value of an asset is. Okay, and that is chapter 6 of the conceptual framework. This is important because this is everything we'll be learning. As we pick those items one by one, you see me recalling most of these things that I've mentioned here. I'll be recalling them because this is the principle. This is where everything is sitting on, right? And I mean, if you look at these historical costs, it's easy to recognize, but it makes the report very irrelevant because it does not change. Meaning that if you buy an asset 5 years ago, today you will still be putting that asset at the cost you bought it 5 years ago, even though things have changed. And that's where current value comes in. This is updated for changes economic circumstance. Is either you are using current cost if you want to replace your asset, or you're using fair value if you want to sell the asset, or you revalue the assets by looking at the PV of future cash flows from this asset. But it clearly shows the value of the asset today. Okay, so that's chapter 6 of the conceptual framework. Chapter 7 of the conceptual framework talks about presentation and disclosure. So we have really talked about all the items, the elements, the measurements, the recognition. Now, so this chapter 7 talks about how the elements are presented in the financial reports. Okay, how they are presented in the financial reports. And majorly, income and expenses are presented in a statement called statement of profit or loss. Statement of profit or loss. and other comprehensive income, while assets, equity, and liabilities are presented in the statement of financial position. That's basically how we present it. And in some cases, income and expenses can be presented in the other comprehensive income, where management of the entity, when management of the entity believes that it's presenting it that way, believes that it will faithfully represent the item by presenting it in that manner. And this is usually the case. Where an income or expense is unearned. So when you have income that you have not actually earned, okay, or you have expense that might reverse, so we usually put them in the other comprehensive income. Okay, we put them in a statement called OCI. You learn more about this. These are just principles that I'm trying to lay here. And with regards presentation, we would still talk about aggregation, trying to not present too many details in the reports. Though we have IFRS 18 and IAS 1 gives us a template where you will not just present unnecessary details in the account. So chapter 7 teaches us speaks on all of those things. And also it talks about we should not have a standard template, that you should report your activities based on the nature of your activities, but don't present unnecessary details. If you have similar expense, group them together. If you have items that are similar, group them together like that. So it says a lot around. So that's majorly the entire gist around chapter 7. And chapter 8 talks about concept of capital and capital maintenance. So you see, concept of capital and capital maintenance, I will present it from two angles, right? So the first one is that concept of capital. So when we say capital, majorly we're talking about ordinary share capital, preference share capital. We're talking about that the capital as you know it, right? So we have financial concept of capital, which is this is the monetary amount of capital, or what we call net assets or equity, right? That's financial concept of capital. But there is another concept of capital which is unused, but it exists. So this is capital as this is the operational and physical capability or capacity of an entity. So this is capital as your operational or physical capability or capacity in terms of the amount of units you're able to produce, in terms of your your purchasing power, in terms of what you can actually do as an entity. So see, this sees capital as productive capacity of an entity. What can you produce? That's your capital. What can you produce today? That's your capital, right? So you cannot be parading 100 million, right? And last year, 100 million can produce 1,000 units of your goods. But 100 million this year can only produce like half because of inflation. And that's what physical capital, concept of capital comes in. That don't look at the money, look at your operational and productive capacity, your operational capability. That's what you should look at. And that's what physical concept of capital is talking about. And that takes us to capital maintenance, right? So again, based on the concept of capital, we can also look at when have you maintained your capital. Okay, so financial capital maintenance. So this is financial concept of financial capital maintenance. So this occurs where an entity makes profits or breaks even. And this happens where its opening capital is lower than its closing capital, right? So if your opening capital is 10,000 and your closing capital is 12,000, you have maintained your capital in the sense that you have made a profit of 2,000. But for physical capital maintenance, this also occurs when an entity makes profits. Yeah, capital maintenance is about making profit or breaks even for either of the two. But the context is different because for physical, this really happens where the productive capacity at the beginning is lower than the productive capacity at the end, right? So what we are saying here is this: if your opening capital, of course, it's usually expressed in money, but let's say the goods you produce per unit is 10 naira, which means you can only do 1,000 units of goods. This is your productive capacity. This is your productive capacity. This is what we see as your capital. So you have your money, you translate it to what you can produce. That is your productive capacity. If your closing capital at the end is 12,000, but the same goods can now be produced for 15,000. So how many units can you produce now? How many goods can you press your calculator? You guys, you're in reporting class. You don't have calculator. Better get used to having your
800.
calculator. 800 units. So this is this guy productive capacity. this guy has not maintained his capital. Even though if you look at the money, yes, it went up, but his productive capacity has declined because of inflation. The same goods he could produce for 10 naira per unit. Now you can do it for 15 naira per unit. Okay, so I've spent beyond my allotted time for this class, and because I know you guys don't have any other course again after now, so we might be doing more of that, and let's see how it goes anyway, just so that we can finish our syllabus as early as possible. Even though, like I told you yesterday, we are not in a rush to finish syllabus. We know we are going to finish, but the race is not finishing syllabus. The race is creating depth. The race is about you understanding all of these things deep down. So I'm done with topic 2, right? See, the best thing for us to do is for us to solve past questions on these 2 topics. If you can look at our past questions and see all the questions they have asked on regulatory framework and conceptual framework, let's solve everything, maybe from 2018 to date. And that's what we're going to do in our next class before we go to the next topic. My next topic with you is I'll be talking about ethics. I'll be talking about sustainability reporting. I'll be talking about sustainability reporting. I'll be talking about technology as it affects reporting, right? That's my next topic. When I'm done with that, I will move to ratio analysis. I'll move to ratio analysis. When I'm done with that, then I'll teach you IS 1 vis-a-vis IFRS 18, the new introductions from IFRS 18. Then I will then move on like that. We'll move on very fast. So depending on my timing and my schedule, we're just starting the diet. So I'm looking at what happens. You guys should be ready to make sacrifices. You should be ready to give it everything you have. This is a project and it's not forever. It's not forever. So let's put in all dedication. Don't fail. Don't fail. That's your first mission. Don't fail. It's not good to fail. After making all efforts, you come to class, you paid money, you now fail. Don't fail. And we are going to try our best to make sure we will teach you. I will teach you everything in the syllabus. I would solve past questions. We would present it in a very simple way. We know it. It's not something new to us. But if you don't read it, it's useless. What I've taught you yesterday and today now, if you don't read it by next week, by next week, you have forgotten everything. You will not remember anything. So this class you have then attended has no value. It has no value because it will now be as if you are now reading on your own. But it will have more value as I've taught you, I've done some explanations. And this note is like a summary. I'm not really writing everything. I'm explaining and I'm writing like that. If you pick it up, now I've done two topics and it's just 8 pages. So it's not much now. So next week now, it will become more because we'll solve past questions next week. We would solve past questions next week. And I'm going to be dropping, somebody said I should drop the raw video. No problem. I will drop the raw video for you. But the edited video will also be dropped later today by the special grace of God. Everybody will have access to all the videos for all the courses by the end of today. But please, let's go and read these 2 topics. They are so important. You will see when we solve past questions next week, you'll see exactly what I'm talking about. And in case of any flexibility, we say, yeah, come, let's do extra class, let's do this. please always don't fight it. Don't fight it. When somebody say that let's have this extra class. Don't start fighting it. No, you don't want to. It's a temporary project. So we are all in this together. Let us pass at one sitting. That's the joy. All right. Do you have any questions? Let me drop this note immediately. I'll be updating it every day and I'll be dropping it almost immediately. Let me drop it while I'm here.